purpose of this video is to walk you through the labor variance analysis that we tried to walk through in class on Tuesday, but I know was somewhat confusing. So I've summarized all of the information from the example we went through in class on this one Excel worksheet. And again, I'm just going to analyze the labor variances, both the labor rate and the labor efficiency variances. So here's how I'm going to do this. I'm going to first figure out what's going to work its way through our manufacturing costs for labor. And we said with a standard costing system, the amount that goes into the work in progress account is the labor costs at standard cost. So I have this standard cost sheet here, and it tells me what my labor costs are right here, 85 cents a bottle. And it breaks that down further into the two departments that I have. So I know I should have 85 cents for every one bottle that I complete. And what we know here is that we have a mixing department, a bottling department that work for differing amounts of time, but we'll assume that they complete 9,250 bottles of soda. So I know that we should put in a work in progress for the labor 9,250 bottles times 85 cents because it goes in at standard cost. So 9,250 times 85 cents, 7,862. Now, the problem is we have to follow the labor laws, and the labor laws say you pay your employees for hours that they work, not necessarily what your standard costs are. And we're told up here that we have one employee that works for 163 hours and earns $16 an hour. So I'm going to put right over here under this pay column. For the mixing department, we have to pay someone 163 hours times $16 an hour. And we have to pay someone in the bottling department for 500 hours that they work times $12.50. So I have to pay in total $88.58. Remember, the standard allows 25 cents for every bottle in the mixing department and 60 cents for every bottle in the bottling department. So there's the standard allowed. The standard allowed works its way over to the work in progress. Now my wages payable, what I actually pay the employees, is the $88.58. So at this point that journal entry doesn't balance because I'm putting in the inventory account at standard and I'm paying actual. So this difference, this is our variance, our direct labor variance, is the difference between what we pay and what we put into the account at standard. So since a variance account has a debit balance, that's unfavorable. That's a bad thing. Think of this as like an expense account. A debit balance is unfavorable. A credit balance would be favorable. So we know we have an unfavorable labor variance of $995.50. What we don't know is whether that is because of a labor rate variance or a labor efficiency variance. Were we paying them too much, or were they too slow, or some combination thereof? So we're going to break this variance into its two components. And I've got the formulas for that over here, right? So first we'll look at the direct labor price variance. And the formula says to take the actual rate, subtract the budgeted rate, and multiply that by the actual hours. So if we look at the mixing department, the actual rate is right here, $16 an hour. My budgeted rate comes from the standard cost, $15 an hour. Actual hours are 163. So I work this formula. Order of operations are very important. 16 minus the 15 times the 163. We have a $163 unfavorable direct labor price variance from the mixing department. They do the same thing for the bottling department. Actual rate, $12.50. Standard rate, $12. Actual hours used in the bottling department were 500. So, again, I can copy this formula down. And I have, again, an unfavorable variance of $250. It's an unfavorable labor pricing variance in the bottling department of $250. So I add those two together, and so my total direct labor price variance is an unfavorable amount of $413. Okay, now we need to look at the direct labor efficiency variance. At formula is right here. We're going to do it for each department and then add it together. Actual hours, which we've got here, 163, 250, minus the hours allowed at standard. This is the calculation where I think lots of you struggle. The hours are allowed. The way to figure that out is we created 950 bottles. If we make 950 bottles, we're allowed 1 minute in the mixing department for every one bottle. So I could take 9,250 times 1 minute. We're allowed that many minutes, and there are 60 minutes in an hour. We're allowed 154.1667 hours. We multiply that by the budgeted rate, which is right here off the standard, 15. So I take my actual hours, subtract my hours allowed, multiply that by the budgeted rate. Again, I know that's an unfavorable variance because the hours I used are bigger than the hours allowed. So I have a $132.50 unfavorable variance that goes on the debit side. My bottling department, the formula is very similar to calculate hours allowed. 9,250 bottles is what we completed. Each bottle is allowed 3 minutes in the bottling department. So I take 9,250 times 3 minutes, divide that by 60 minutes in an hour. We're allowed 462.5 hours. My budgeted rate in the bottling department is different than the mixing department. It's $12. Carry this same formula forward, and it looks like I've screwed this up, and the way I screwed this up was because I only took 250 actual hours. That is not right. There are 500 actual hours. So we have a $450 unfavorable direct labor efficiency variance for the bottling department. So my total unfavorable efficiency variance is $582.50. Okay, so, oops, I gotta do this right. Is $132.50 and $450 for a net amount of $582.50. Great. So now, what you'll notice is debits don't equal credits when you add all these accounts together. So what really is happening is we're now taking this labor variance account and breaking it into its more meaningful components, the labor rate variance and the efficiency variance. So when you add these two numbers together, let's see if this works. It is exactly $995.50 because we're calculating what those variances are. So we are reclassifying this labor rate variance, or this direct labor variance, into its two components. And so these would be income statement accounts until we close them out at the end of the period. So I hope this is helpful. You can go back and watch it as many times as you want, but that's how we work through the direct labor variances in an accounting system and how it works through the actual accounts.